SoFi's Q1 earnings report is fast approaching. It's actually going to happen on Monday, April 29. So let's go over their own forecast. Let's go over my own projections for a couple of those numbers. And then at the end, let's speculate and see where the stock might go. Of course, do leave your expectations, predictions down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. Very close to 40,000 subscribers, so thank you very much for all the support. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's first up go over the Q1 non-GAAP guidance that they gave us 3 months ago. They expect to deliver between $550 and $560 million in adjusted net revenue and $110 to $120 million in adjusted EBITDA and $10 to $20 million in GAAP net income. Now, as you can see, the year-over-year increase for net revenue is going to be around 21% at the midpoint, adjusted EBITDA $115 million at the midpoint, and around 20% adjusted EBITDA margin, and an incremental adjusted EBITDA margin of around 42%. As for the full year guidance, they expect to deliver tech platform and financial services growth of 50% or more versus 2023 level. With regards to lending segment, as you know, at 92 to 95% of 2023 revenue levels, which means it's going to be lower. GAAP net income of between $95 and $105 million, adjusted EBITDA of between $580 to $590 million, and EPS of around 7 to 8 cents. As for tangible book value growth, that will be between $300 and $500 million. Now, this guidance assumes expenses under the EBITDA line to remain flat, a 50-50 revenue split between lending and the combined tech platform and financial services segment, as well as adjusted EBITDA margin ramping to 30% by year end. Their macro outlook assumptions are as follows. We assume a contraction in GDP in 2024, an increase in unemployment to higher than 5%, and broadly a continuation of uncertain capital markets activity and continued normalization of consumer credit. From an interest rate perspective, we are assuming 4 rate cuts in response to a contracting economy, higher unemployment, and deterioration and normalization in credit performance, with Fed funds rate reaching approximately 4.5% by Q4 2024. Of course, by now, the market does not expect 4 rate cuts, so some are saying this is bearish for SoFi. But if you look at the other assumptions here, contraction in GDP, unemployment higher than 5%, those are extremely bearish cases. If those happen, then you will have rate cuts and quite aggressive ones. So yes, we might not have 4 rate cuts. Maybe we're going to get 3, maybe 2. But the other bearish assumptions here, I don't think we're going to have this year, which should provide SoFi with quite some upside. And so looking at the current analyst estimates for this fiscal year and the fiscal year that follows, 25 and 26, this is from Koifin, link is down in the description and in the pinned comment, for 20% off. So for fiscal year 2024, they expect revenue to grow around 15% year over year, and EPS adjusted of 6 cents. For fiscal year 2025, year-over-year growth for sales of around 17%, EPS to grow to 18 cents, and then in fiscal year 2026, continued acceleration in sales growth by around 21.8% year over year, and EPS to reach 40%. So as you can see, profitability side of the business is about to explode. Right now, as of today, the average analyst price target sits at $9.16, representing close to 27% upside from the price we're at today. Year to date, the stock is down 27%. So let's start with a couple of projections here. This was the members number for last quarter. So they added 585,000 in Q4, bringing the total over 7.5 million. That's up 44% year over year. Now the CAC for Q4 was $299. I expect Q1 new members to be slightly higher than Q4 at 590,000. And so the CAC for Q1 will be a bit lower than in Q4, $296. How do you get that? You basically go and look at the sales and marketing expense, which I believe is going to remain flat at 175 million. You then divide it by this number, the new members, and you get that number. Of course, right now it is still quite high. As for a Galileo account, we finally, right in Q2 of 2023, saw a reacceleration of Galileo. Now they have 145 million accounts. That's up 11% year over year. Now, Q4 revenue was $96.9 million. That was also up 8% quarter over quarter. They also expect between 2023 and 2026 mid-20% growth rate. And so I expect Q1 revenue to be above $100 million. And if you remember from the last earnings call, Anthony Noto's comments here. So for the 2023 through 2026 time period, we see 20 to 25% compound annual growth, assuming no meaningful change in the macro environment and no significant new business launches or acquisitions, such as small medium business checking and savings, or small medium business lending, a broader asset management business, insurance, a broader credit card portfolio, new technology verticals for the technology platform business, or new geographies. And these take into account their own macro assumptions, by the way. The 20 to 25% compound annual growth from 23 to 26 assumes a compound analytic growth rate of 50% for financial services revenue, mid-20% for tech platform revenue, and mid-teens for the lending segment revenue. The earnings power associated with this growth is notable and could drive between 55 to 80 cents per share in GAAP EPS in 2026. Then beyond 2026, they say here, we see 20 to 25% EPS growth beyond 2026. So there's definitely quite a lot to be excited about. Now, it's all about execution, but if history has taught us anything with regards to guidance, management executing, is that, well, they deliver, and usually they guide conservatively so they can beat that and raise accordingly. Now, if we go and look at the quarterly adjusted net revenue and quarterly adjusted EBITDA, last quarter for net revenue that came in at $594 million. Adjusted EBITDA had a great quarter there, so quarterly adjusted EBITDA came in at $181 million. I expect Q net revenue of $565 million, beating their own guidance by a little bit. Quarterly adjusted EBITDA of $123 million. The high end for them, for their guidance, as we've seen, is 120. So yes, I do take those numbers that they gave us and add a little bit to that because of their own track record. With regards to GAAP net income, I say here I expect a tiny beat on EPS. So GAAP net income, as we've seen, between $10 to $20 million, representing 0 to 1 cent EPS, because you have to take into consideration Q1 layoffs and the 2026 convertible notes buyback. As for quarterly deposits, this was a quote that was given by the CFO, I believe, a month or two ago. So they expect to continue adding $2 billion or more in quarterly deposits for the foreseeable future. So in Q4, they added $2.9 billion. I expect Q1 to be above $3 billion, which would bring the total at around, I believe, 21.6-ish. And so right now, if we look at the stock, we're at $7.23. This is on the weekly, by the way, which means we are below the 20, the 50, and the 200-day moving average. Last quarter, of course, which was around right here, we were a bit higher before the earnings report. Maybe we're going to end this week at the same levels, but don't get your hopes up. So yes, previously, as you can see on the weekly, that candle was above the 200-day moving average, but then as the usual SoFi stock reaction is triple beat, then the stock reacts accordingly, which means huge gains during the day or maybe two, but then the crash, the dip follows. And so let's hypothetically say that we stay at the same price we're at today, but fast forward Monday after they report earnings and we have the same jump that happened before, which is around 18-19%. I put it at that. Let's expect the same reaction, let's say. Again, these are just assumptions. We can go lower, we can go higher as well. That means that we will reach around $8.60, which also means that, this is by the way on the daily, we have that little gap here between $8.55 and $8, which could get filled, especially if we stay above that 200-day moving average. Again, this is just speculation, crystal ball type of thing. But overall, what we want to see is the business continue to perform across the board and the stock will just react accordingly. Of course, macro environment is still not great. So as long as the business is performing, as long as management is executing, who cares? Because in the long run, the stock will reflect how well or how bad a certain business is doing. So that will be it for this video. Like I said, do share your predictions down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.